On the morning of November 6th, 2025, at 8:43 Eastern Time, Dr. Ned Mamula sat in a conference room at the U.S. Geological Survey headquarters in Reston, Virginia, holding a 60-mineral list that would rewrite the rules of global commodity markets. At 67 years old, Mamula was a former Pittsburgh steelworker turned geologist who had spent 38 years watching America surrender its mineral independence to foreign suppliers. He had been confirmed as USGS director exactly 1 month earlier, after testifying to Congress that removing copper and uranium from the critical minerals list was foolish and that America's reliance on China and Russia had reached unprecedented and dangerous levels. The financial media told investors that industrial metals were oversupplied. The analysts told pension funds that silver was a volatile speculation best avoided. The commodity desks at Goldman and J.P. Morgan had dismissed critical mineral policy as bureaucratic theater that rarely moved markets. But Mamula had added 10 new minerals to the list that morning, including one that had never appeared in U.S. critical mineral policy in the nation's entire history: silver. By that afternoon, the official press release was buried on page 4 of the Department of Interior website. No headlines, no CNBC alerts, just a technical update stating that silver now qualified for Defense Production Act funding, tax incentives, and strategic stockpiling authority. The silver futures market barely flinched. Spot price held steady near $31 per ounce. Traders assumed it was symbolic, a nod to solar manufacturers and EV supply chains, nothing that would actually change the flow of metal. But in October, 1 month before the announcement, a former Pentagon official had told the Financial Times that the Defense Department was incredibly focused on the stockpile and looking for more in a deliberate and expansive way. The Pentagon wasn't asking for silver. It was warning the market to get out of the way. On December 9th, 2025, silver broke $61 per ounce, a 90% gain in 12 months. The COMEX vaults held just 47 million ounces available for delivery. The U.S. government had just declared silver critical to national security, and Wall Street was still pretending the paper price was real. Let me tell you what actually happened on November 6th, 2025, while you were busy arguing about tariffs and inflation on social media. The U.S. Department of Interior quietly published a technical document that most investors never read, a 60-mineral critical minerals list that added 10 new entries for the first time in years. Buried in that list, between silicon and tungsten, was a metal that had never appeared in U.S. critical mineral policy throughout the entire history of the Republic. Silver, not gold, not platinum, silver. The mainstream financial press treated it like a footnote. Bloomberg ran a 2-paragraph brief. CNBC didn't mention it at all. The commodity trading desks at the major banks filed it under regulatory updates and went back to their algorithms. But if you actually read the technical justification, the language was anything but routine. The department cited import dependency, supply chain concentration, and national security applications. Translation: America doesn't produce enough, relies too heavily on foreign sources, and needs it for defense systems that can't function without it. Here's the number. Wall Street didn't want you to notice. The U.S. imported 64% of its silver consumption in 2024, primarily from Mexico and Canada. That's not a commodity, that's a strategic vulnerability. And the official explanation: industrial demand is up. Government wants domestic supply, standard policy stuff. Except nothing about this was standard. Critical mineral status isn't symbolic paperwork. It triggers 3 specific mechanisms that change the economics of an entire sector overnight. First, Defense Production Act authority, which means the federal government can fund mining projects, direct supplies to defense contractors, and build strategic stockpiles without asking Congress for permission every time. Second, tax incentives, a 10% production cost credit available through 2030 for domestic miners. Third, $2 billion in national defense stockpile funding allocated under the One Big Beautiful Bill Act, ready to deploy the moment a mine qualifies. Now, let me introduce you to Ross McElroy, CEO of Apollo Silver, who controls America's second-largest primary silver deposit in California. His Calico project holds 125 million ounces of proven silver reserves. When the critical mineral announcement hit, McElroy didn't celebrate with press releases or investor calls. He called his legal team about Fast 41 permitting the government's express lane for critical mineral projects that can cut approval timelines from 10 years to under 3. While traders were still debating whether the policy change mattered, McElroy was already positioning his company to be first in line for federal funding and accelerated permits, because he understood something the paper market didn't. When the government declares a commodity critical to national security, it's not making a suggestion. It's issuing a warning. So why silver? Why now? Because silver isn't just shiny metal that looks good in jewelry. It's the most electrically conductive, thermally conductive, and reflective element on the periodic table. That's not marketing language, that's physics. And physics doesn't negotiate with supply chains or commodity traders. This fundamental property creates three demand engines that cannot be reversed, postponed, or substituted away. Let's start with the biggest. Solar panels consumed 197 million ounces of silver in 2024, nearly 20% of total global demand. Every single panel requires approximately 20 grams of silver in conductive paste because nothing else can handle the electrical load and temperature fluctuations without degrading. China alone plans to add 160 gigawatts of solar capacity in 2025. But here's the part that breaks the supply model. Advanced TOPCon solar cells, which represent the next generation of efficiency improvements, require 50% more silver than traditional panels. So the industry's solution to the supply crunch is to build better panels that consume even more of the metal they can't source reliably. Then you have electric vehicles. A conventional gas-powered car uses 15 to 28 grams of silver in its electronics. An EV uses 25 to 50 grams because of the higher voltage systems, battery management electronics, and charging infrastructure. Global EV production is targeting 18 million units annually, and every charging station adds another layer of silver demand. Multiply that across the grid, and you're looking at structural consumption that grows faster than mine production. But the wild card, nobody's pricing in yet. Artificial intelligence data centers. Global IT power capacity increased 5,252% from 2000 to 2025. AI chips generate extreme heat loads that copper simply cannot handle. Silver's thermal conductivity is irreplaceable in cooling systems and high-frequency circuit boards. One large-scale data center can consume millions of ounces annually, and we're in the early innings of AI infrastructure build-out. Now here's where the chemistry becomes a crisis. You can't substitute silver in these applications. Copper conducts 94% as well as silver on paper, which sounds close enough until you understand what happens in real-world conditions. Copper oxidizes at the high temperatures inside solar panels, causing efficiency loss and panel failure. It can't handle the thermal loads in AI chips without warping. It degrades in automotive electronics under voltage stress. This isn't a cost preference, it's a chemical constraint. Engineers at Samsung and TSMC have quietly redesigned their manufacturing processes around one limitation: silver availability. They've reduced silver loading per chip by 30% since 2020, not to cut costs, but because they can't secure reliable supply for future production volumes. When the world's leading semiconductor manufacturers start designing around scarcity rather than cost optimization, you're no longer in commodity territory, you're in strategic resource allocation. So where's all this silver supposed to come from? Let's look at the actual numbers, not the projections analysts feed to pension funds. Global silver mine production in 2024 reached 819.7 million ounces, up to just 0.9% from the prior year. Add in recycling, and you get roughly 1.01 billion ounces of total supply. Total demand? 1.16 billion ounces. That's a deficit of 149 million ounces in a single year. But that number hides the real crisis, because this isn't a one-year anomaly. We just completed 5 consecutive years of deficits totaling 800 million ounces since 2021. That's nearly equal to an entire year of global mine production that simply vanished from inventories. And here's why it can't be fixed quickly, no matter how high the price goes. 72% of silver comes as a byproduct from copper, lead, and zinc mines. Let that sink in. Silver isn't mined because miners want silver. It shows up as a side effect of digging for other metals. So when silver hits $100 per ounce, it doesn't matter. You can't ramp up silver production unless copper demand justifies opening new copper mines. And new mining projects require 7 to 10 years from discovery to production, assuming you get permits, financing, and community approval without delays. Even worse, silver mine output peaked in 2016 at roughly 900 million ounces and has been falling to 820 to 835 million ounces by 2025. Ore grades are declining. Major producers in Mexico, Peru, and Bolivia are facing regulatory delays and political instability. The structural production curve is pointing down while demand is accelerating up. So where did the deficits come from? Somebody had to supply that missing 800 million ounces over 5 years. It came from the vaults. COMEX registered silver inventories collapsed 70% from 346 million ounces in 2020 to 82 million ounces by late 2023. London vaults saw 40% stock reductions between 2022 and 2023. Industrial stockpiles that used to cover 90 to 120 days of consumption now cover only 30 to 45 days. And here's the admission nobody wants to talk about. The U.S. Defense Logistics Agency's National Defense Stockpile does not list silver as a current holding. America's strategic reserves were liquidated through the 1990s. Translation: the Pentagon has zero buffer for defense needs at the exact moment it declared silver critical to national security. The projections for 2025 set to be the fifth successive year of structural market deficit with no resolution in sight. Even if every solar manufacturer cuts silver usage by 25% through engineering miracles, installation volumes are rising faster than efficiency improvements. The deficit isn't shrinking, it's compounding. And the paper traders holding contracts they assumed they could settle in cash are about to learn the difference between a price and a delivery. Now, here's where the optimists jump in with their easy solutions. Just recycle more silver. Recycling hit a 12-year high of 193.9 million ounces in 2024, up 6% from the prior year. Sounds impressive until you remember that total demand is 1.16 billion ounces. Recycling covers just 17% of total consumption. Even if the industry manages to push recycling to 200 million ounces in 2025, it falls drastically short of closing perpetual deficits that are draining physical inventory from vaults every single quarter. You can't recycle your way out of a structural shortage when the gap between supply and demand keeps widening. Fine, say the analysts. Just open new mines. Let's run those numbers. U.S. domestic mine production in 2024 was approximately 1,100 tons, with an estimated value of $960 million. That's roughly 35 million ounces, barely 3% of global supply. And here's the timeline problem that Wall Street refuses to acknowledge. Copper mines in the United States take an average of 24 years to become operational from initial discovery to first production. 24 years. Even primary silver projects require 7 to 10 years under ideal conditions. Exploration is yielding fewer greenfield discoveries despite spending increases, and reserve replacement is lagging behind consumption across the entire industry. By the time new mines reach production, electric vehicles and solar installations will have consumed another 2 to 3 billion ounces. The deficit doesn't wait for permits. Okay, last hope. Just use copper instead. Already tried. Companies like First Solar are actively developing copper-based alternatives and optimizing silver paste usage to reduce costs and supply chain risk. The result? Innovations are still in early experimental stages, and advanced solar cells like TOPCon and HJT heterojunction technologies continue to require 150 milligrams of silver per watt because physics doesn't care about your cost reduction targets. Copper oxidizes, copper fails under thermal stress, copper degrades in high-voltage automotive systems. The substitution narrative sounds great in investor presentations, but the engineering reality is that after a decade of research and hundreds of millions in development spending, the industry is still designing around silver as the irreplaceable core material. Now let me show you who understands this better than anyone on Wall Street. In October 2025, a former Defense Department official told the Financial Times that the agency is incredibly focused on the stockpile and looking for more in a deliberate and expansive way. This wasn't a policy announcement. This was a warning. The Pentagon doesn't issue statements like that to inform the public about routine procurement. They're signaling to the market that they know recycling won't work, new mines won't arrive in time, and substitution is a fantasy. And when the Department of Defense admits it's buying physical metal in a deliberate and expansive way, that means the strategic squeeze has already begun and the paper price is living on borrowed time. So let's connect the dots between policy and physics. Because November 2025 wasn't just another bureaucratic report gathering dust in a filing cabinet. It was a strategic pivot that fundamentally changed the economics of silver from commodity to national security asset. Silver's designation as a critical mineral unlocks Defense Production Act funding, tax incentives, and potential government stockpiling authority, treating it exactly like lithium and rare earths. This isn't symbolic. This is the federal government announcing it will compete for physical metal in a market already running 5 consecutive years of deficits with collapsing vault inventories. Here's who wins in this new landscape. Primary silver miners like Ross McElroy's Apollo Silver, which holds 125 million ounces in California's Calico project, suddenly gained Fast 41 program eligibility for streamlined permitting that can cut approval timelines from a decade to under 3 years. They now have access to $500 million allocated to the Department of War's credit program, specifically for critical mineral loans. They qualify for 10% production cost credits through 2030. Meanwhile, every established copper-silver operation in friendly jurisdictions just became a strategic partner to the U.S. government instead of a vendor to the industrial market. The pricing leverage shifted overnight from buyers to sellers. And here's who loses. Paper traders sitting on COMEX contracts, assuming they can settle in cash or roll positions indefinitely. COMEX registered inventory available for immediate delivery is currently just 47 million ounces. Total silver in the COMEX system is 291 million ounces, but the vast majority sits in eligible inventory where owners must be persuaded to register their bars before that metal can be sold and delivered. Good luck persuading vault holders to part with physical when the Pentagon just announced it's buying in a deliberate and expansive way, and solar manufacturers are panic bidding for supply. The paper market works beautifully when everyone agrees to settle in cash. It collapses instantly when someone demands delivery and there's no metal left to deliver. Silver shattered all-time highs exceeding $61 per ounce in December 2025, representing a 90% year-over-year gain. The financial media called it a speculative rally. The commodity analysts called it a squeeze that would reverse once volatility subsided. But the critical mineral designation wasn't causing the rally. It was confirming what the vault data, the deficit numbers, and the Pentagon's quiet admission already proved. Supply is extinct, demand is structural and accelerating, and the paper price was living on borrowed time from the moment the government decided silver was too important to leave in the hands of derivative traders and foreign suppliers. When governments classify something as critical to national security, they're not asking permission to buy, they're not negotiating with markets about fair value. They're warning you to get out of the way because the strategic imperatives just overrode every assumption the commodity desks built their models on. And if you're still holding paper contracts, assuming you can settle when convenient, you're about to learn what happens when physics, policy, and deficit accounting converge on a market that never actually had the metal it claimed to sell.